This is level 1 of the CFA program, the topic on equity investments and the reading on security market indexes. I wonder if you're as puzzled as I am about the relationship between college and professional sports teams and the gambling industry. I can't watch a football game or a basketball game or a golf tournament without seeing some mention that, oh, if you really want to bet on this thing right now, here, go to this application or this web page and just click on this button. And so you'll hear commentators say something like, hey, did you know that in his last 10 games, Steph Curry has averaged 7 threes a game? Or over his last 4 games, Tom Brady has thrown 2 touchdown passes, 4 touchdown passes, and 6 touchdown passes, and whatever. And so I started thinking about this as I'm watching and trying to enjoy sporting events without being distracted by gambling. I'm thinking to myself, of course they're doing this to gauge interest. And the second part of the reason that they're doing this is to help those who are having an increase in interest make well-informed decisions. And that's pretty much what this reading is about, security market indexes. I was fascinated to read in the first couple of pages of this reading. There's a little bit of a history lesson. Those of you who watch my videos know I love history. There's a comment about stock market indexes going all the way back to before the year 1700. But it wasn't until the 1880s and the 1890s when Charles Dow and Edward Jones put together, what's known as the Dow Jones Industrial Average these days. But all I want you to do is think about substituting security returns or security prices for Steph Curry and Tom Brady. Why do we have these security market indexes? Well, one primary way is to get us all interested in the stock market or the bond market or the alternative security market. And then the second part is those of us who are interested in it, how do we measure performance? And you'll see that as we go through this slide deck. But notice the LOSs. There are a whole slew of describes, and there are a handful of calculates. So essentially what we're going to do is describe Steph Curry's threes and calculate Tom Brady's average number of touchdown passes over some time period. And that's what we're doing, like describe a security market index. Look, describe types of equity, describe types of fixed income, describe alternative investments, and then somewhere in there we're going to have to calculate and interpret some of these indexes. All right, let's go ahead and start with the super basics here. Security market index is used to represent performance. All right, so there we go. Performance of, maybe a specific asset class or a security market or a segment, or as we'll see later on in this slide deck, maybe a particular style or maybe some unique aspect. I mean, let's face it, I could come up with Jim's stock market index, and I can include my favorite 8 stocks in this index. Of course, I'd have to tell you what those favorite 8 are, but you could measure the performance of my 8 stocks if you followed my index every day. Yeah, look at that second embedded bullet point, created as portfolios of individual securities. And that's why, and can I give you a little preview of what we're going to be headed into very shortly? In a future reading, we're going to talk about William Sharpe and the capital asset pricing model. And in 1964, William Sharpe, among others, came up with this idea of a market portfolio. And then inside of that capital asset pricing model is a well-diversified return on that market portfolio. And so indexes, really, just think of them as, boy, I'm going to go ahead and say this, but don't tell your finance professors I said this. I'm going to go ahead and say that all indexes are diversified portfolios just because they have a bunch of stocks or bonds or hedge funds in them. Now, notice I didn't say that they were well-diversified portfolios. To get a well-diversified portfolio, you probably need to go to at least the Dow Jones, which has 30 stocks. You probably need more than that. Maybe the S&P 500, which has 500 stocks, or even better still, the Wilshire 5000, which of course has 5,000 stocks in it. Did I get you on that one? You should have been right all over that. You should have said, you know what, Jim? When Wilshire created this in 1974 or something, they started out with what they thought were going to be 5,000 stocks, but that number has fluctuated. It's been as high as almost 8,000 sometime in the 90s. And I think in 2022, it's less than 4,000. Anyway, it's a bunch of stocks, and it's a well-diversified portfolio. So the index has a numerical value, and we can compute that index return by just taking essentially an F over P minus 1, a future over present minus 1, and that's going to give us, and you'll see that here in just a slide or two. Let's see, we can have a couple of different ones. We can have a price return index, which is based just on prices, or we can have a total return index, which is based both on prices and the income. So of course, with an equity total return index, you would include all the dividends received. For a fixed income total return index, you would include all the coupon payments or the interest payments that were received. And then, of course, if we had, Jim's equity and fixed income index, then we'd have both prices and dividends and interest income. All right, here's our first calculate. So let's go ahead and start with value, price return, and total return. So the value of a price return index. So that's the VPRI on the left-hand side of the equal sign. And notice what we're going to do. We're going to take a summation from I equals 1 to n. And so this would be, if this were the Dow Jones, this would be I equals 1 all the way up to 30. So what we're going to do is take the number of units in the security, which would be number of shares, right? And then that P is going to be the price. So all we're going to do is take, units times price. And then we're going to divide by, well, you would think that we would divide by N, right? If this were the Dow Jones, you would think we would add those. We'd add all those up and then divide by 30. That makes perfect sense, right? We learned that back in kindergarten. That's an average, right? However, lots of things happen over the course of the index's life. There are things like stock splits and stock dividends and mergers and equity carve-outs and all those fun things that we'll talk about in a future slide deck. But the way the reading presents this is that if I were coming up with Jim's price return index, what I would do is I would select an initial value of the index, like 100 or 1,000, or 12,465,000. I mean, I could pick any number. And so what we do is we solve for the value of the divisor that would force that index to be 100 or 1,000 or whatever crazy number I just said a minute ago. There we go. Initially chosen at inception, and there it is as $1,000. And then notice the second bullet point. The index provider then adjusts the value necessary to avoid changes in the index because of all those things that I talked about. So let's do a quick example so that you can attack this LOS part that asks you to calculate. All right, so here we have 50 and 10 and 30 and 100. And so what are we trying to do here? Let's go ahead and figure out what must the divisor be in order to have a beginning value of 1,000. Because after all, the Dow Jones Industrial Average, at some point it was 10,000, then it was 20,000, then it was 30,000. Hasn't hit 40,000 yet, but who knows? I do remember the first time it hit one of those major numbers was back when my mom was still alive, and she called me on the phone. She said, "Oh, Jimmy, did you see the Dow is up over 10,000?" And I was like, "Okay, Mom, that's pretty exciting, but I'm pretty sure it doesn't really mean anything other than it's going up." So, all right, so just do the math here really quickly. This is just algebra that you learned probably years and years ago. So we have stock A and stock B, their total value is 3,500. And so we want we want the index to be 1,000. So just do the quick algebra there at the bottom. And so there's the divisor of 3.5. Now this is what I was saying earlier. Here's the formulas for price return and total return. And notice for the price return index, that's notice there's a subscript 1 and a subscript 0. But I always teach my students just to do an f over p minus 1, do a 1 divided by 0 minus 1. And you can't quite do that over on the right-hand side for the total return index because you have to add in, well, what did we say? The dividends and the coupon payments. And, I mean, I imagine there could be other stuff out there, but pretty much that's just the two types of income that are out there. I mean, I guess, a company like Mattel could say, you know what, we're not giving out a cash dividend this year. We're going to send out a bunch of Hot Wheels cars to all of our shareholders. And so I'm guessing the government would be interested in that as a taxable event. So you'd have to add dividends plus interest plus Mattel cars in there. I don't know. I have no idea how you'd have to do that, but you might have to consider that in some scenarios. All right, so let's do just a quick example here that's a little bit more complex. So we want to calculate the 1-year price return and the total return. So notice we have 5 securities going down the left-hand side. And by the way, I don't think I mentioned this a minute ago. These are called constituent securities. That just simply is a fancy word saying that, hey, they're included in the index. All right, so there are the units. There's the beginning value and the ending value in columns B and D. And so just quickly, look at B and D. So we start with 107, we go up to 116. We start with 55 and 62. So notice all of these ending values are higher than the initial value, plus they receive some kind of a dividend. So this is going to be a 1-year price return and total return that's positive, right? So let's go ahead and do the math. And so all we're going to do is we're going to go ahead and multiply. Here, let me go back here real quick. We're going to multiply the 5 times the 107, right? And the 775 times the 55. We're going to do that for all 5 stocks. And that's our initial value, the 1866. And then we do that once again. Here, I'll go back just quickly. So we're going to take the 5 times the 116 plus the 775 times the 62. So you do all that math. So you have a beginning value of 1866. You have an ending value of 2115. And so really the easiest way to do this in your calculator is just to do f over p minus 1. Now we put it down there, price return equals 13.37%, but I'm voting that you just say 2115 divided by 1866 minus 1, and that'll give you the 1337. And then it's not quite as simple as the price return is that the total return is, but notice we put in red there, you got to add the 3910 worth of income. So of course, total return is a little bit more than the price return. So that takes you through the calculate part of this LOS. And I'm guessing that, if I were creating these questions, I'm guessing that the Institute is probably thinking like I am. There's no reason to give you, let's say, 30 or 40 stocks, right? So then, you'd be punching away. And I guarantee if you're like me, you'd make a mistake in there somewhere if you're trying to do this for 30 stocks. That's why the Excel spreadsheet is so valuable. And so look for a table like this on the exam that has, I wouldn't be surprised if the Institute gave you just three stocks, 4 or 5. I would think 5 is the limit. Really, don't look for 8 or 10. And if they give you 30 or 40 or 100, just pick a letter and move on with your life. That's terrible advice, but that's probably what I would have done. All right, how about choices and issues in index construction and management? All right, so what were we talking about earlier? We were talking about Steph Curry and Tom Brady and then Jim's 8 stocks, right? So what we need to do is figure out when we're crafting this index, who is our target audience? Do we want to appeal to these people over here, or these people up here, or these people down here? And these people are unique by things like Well, we have it in bold there: asset class, economic sector, geography, maybe a specific exchange, maybe company size, maybe growth or value, or maybe some crazy kind of characteristic like number of board members that have served for greater than 10 years, or pick some firm specific piece of information that you, or at least the index constructor, thinks is important, and that it has a target audience out there. And then, of course, once you select that target, and let's just take a simple example. Let's suppose that we want the largest firms that are trading on the floor of the New York Stock Exchange. And by largest, I mean greater than the 50th percentile, right? So, how many stocks are traded on the New York Stock Exchange in 2022? Maybe 3,000 or so. So let's say that, our sample then, our population would be 1,500. So do we want to have all 1,500 in that index, or do we want to pick, boy, look at what we have in bold, a representative sample? Because think about it, if you put all 1,500 in there, here, let me go back here just quickly. Look at all the math you have to do. Now, of course, you're going to do this with Excel or some other kind of software, but you're still going to have to be stressed out about all 1,500 of those stocks. How about if we just pick a representative sample of 75 of them? Call it Jim's 75. And then we're going to have to decide how much are we going to value these in relation to all of the other stocks. I mean, if we pick Jim's 75, we could equally weight them, right? 1/75 is the weight for each one of those representative sample securities. Or we could weight them by some other measure. We could weight them by price. We could weight them by value. We could weight them by their dividend. We could weight them by their free cash flow. Now, of course, when you get into things like a dividend and to free cash flow, those statistics come out, probably quarterly, and you're trying to value the index every day, or at least maybe every hour or every minute or every second of every day. And so that might be less useful of a weighting characteristic, but you get the idea that you can weight these really however you want. And then, of course, over time, think about this. You have, let's suppose in Jim's 75, you have 70 stocks who stay the same for some crazy reason. Over the course of a month, they're the same stock price. But the other 5, they all triple and quintuple and octuple and whatever those big words are. So those 5 stocks, they go up dramatically. And so if you're still weighting them 1/75, well, then your original idea is probably lost. So you might have to rebalance those over time. And then, of course, I may not like 2 or 3 of those stocks in Jim's 75, so I could get rid of them. And I could add some others. I could change Jim's 75 to Jim's 85. Or like the Wilshire 5000, I could just keep calling it Jim's 75, and sometimes I have 82, sometimes I have 95, sometimes I have 1. Well, that probably wouldn't work very well. All right, how about a price weighting scheme here? This is just a simple arithmetic average. And this is the important part here of interpreting it. It is always biased toward high price stocks. I mean, think about it. Suppose we have 5 stocks, and 4 of them all trade for $1. So you have $1, $1, $1, $1, and that's $4. And your 5th stock trades for $1,000. So you have, what is that, $1,004 if there's 1 share outstanding. And then if that high price stock moves to like 10%, well, then it's going to dominate the index. Of course, it's going to dominate. So this is what we were saying earlier about the divisor must be adjusted for stock splits and stock dividends and a whole bunch of change of control transactions. So let's do a quick example here. So we have 3 stocks. There's a December and a January price. So our index for December, it turns out to be 40, right? We just sum those and divide by 3. We learned that in kindergarten, always divide by n. And then in January, you have, 45. So there's my F over P minus 1. That gives us a return of 12.25. 12.5%. Whoops, I didn't mean to go forward there. Sorry about that. And so clearly we've gone from 20 to 30 and then 70 to 80, but in the middle row stock went from 30 down to 25. And so this is what really is the idea behind the crafting of these indexes. What you're trying to do is not look at the individual components of a portfolio, but how the portfolio performed in general. So these three stocks, on average, from December to January, increased by 12.5%. Of course, that doesn't mean that each of those individual stocks increased by 12.5%. I mean, you can see the math there right in front of you. And so the indexes really are a measure of overall performance of the diversified portfolio. Notice I didn't say well diversified. It's still, I mean, three stocks here is more diversified than one stock. And we'll talk at length about systematic risk and unsystematic risk in a future reading. Well, we might as well go ahead and extend this example to include a stock split. So look right above the table. We have A and B. They're still the same as they just were, but C has a 2-for-1 stock split. So the question then becomes, well, what happens if, and now look at row A, we have 20 and 20. We have row B, 30 and 30. And we have row C, 70 and, oh, we don't have 70 because of the 2-for-1 stock split. That price is going to be cut in half. So the question then becomes, how do we handle a 2-for-1 stock split? Because, here, let me go back here. If we did the math where the third stock went from 70 down to 35, we'd have a tremendous drop in the index. However, we have had no change in value. All we've had is a stock split. And we'll talk about stock splits in the future, but in the academic world, a lot of times we call these things cosmetic changes, meaning they just kind of, put some makeup on and there's really no substance, no core change. All right, so this is what we need to do. Look down below the table. So before the split, our index was 40, right? We just did that back here. And then after the split, what we want to do is we want to set the index to 40. We want it to remain 40, but we need to solve for the divisor. So if you do that, you get the divisor of 2.125. So the original divisor back here was divided by 3. Here we're going to divide by 2.125. All right, how about equal weighting scheme? All we're going to do, this is my 1/75 that I was telling you just a few moments ago. So we'll just do 1/n, and this is calculated as the arithmetic average return. All right, here's a big old table. So we have securities, 5 of them down the left-hand column. There are total units or number of shares. There's an opening price. There's an ending price. And so what we start with on December 31st, we sum that middle column somewhere in there, we get 10,000. And then we sum that almost the far right column, we get 10,220. So what are we going to do? We're going to say, let's go for our December equal weighted index. We're going to take 10,000 divided by 10. Notice up at the top under the example, it says our divisor is 10. Doesn't necessarily have to be the number of stocks, although that makes sense. That makes common sense. But remember, we can make the divisor anything we want to get the exact index that we want at creation. So that's 1,000. And then the equal weighted index is 1022. So there's the F over P minus 1, 1022 over 1,000. And that gets us to 2.2%. Now look up in the table. You can also do this individually. You can do 2,200 divided by 2,000. That gets you 10%. You can do 2,800 divided by 2,000. That gets you 40%. How about we move on to market capitalization weighting, and notice that over on the right hand side of the equal sign we have Q times P. So we're going to take the number of units or number of shares that are outstanding, that's important here, the number of shares outstanding times the price, and that's going to be our that's in the numerator, and then we just sum all those, and that's going to give us the weight. So this market cap weighting, if you look at that equation, you should be able to see exactly what this equation is telling us. We've got market cap for each stock divided by total market cap that's all out there. And so, going back to my 75 stock index, if this were a market cap weighting scheme, I would take my first stock, maybe there were 1 million shares times a stock price of 100. I'd take 1 million times 100, and that would be my numerator. And then I would divide by the sum of all of those for 75, and that would be my weight for my first stock. And you keep doing this, and you keep doing this. Of course, those weights have to sum to 1. All right, so let's go and look at another example here. We've got 5 stocks going down the left-hand column. There are a number of shares. There's a price. So there's our market cap of 20, 20, 16, 25, and 75. So there's our initial market cap of 156. And the next column are the weights, just like we did right there. And then our ending value, our ending price, 44, 14, and so on. And that gets us our January 31st value. So we have the opening and then the ending. And so 156 down to 144. If we begin our index value at 1,000, we take the ending index value is equal to, so do the 144 over the 156 times the 1,000. That gets us 923. And so there's our index return of a minus 7.7%. Now remember just a minute ago, I said something like, let me go back here. Where did I say that? Look down on the bottom under QI, number of shares outstanding. Well, what do we know? We know that even though there might be lots and lots of shares outstanding, that number might not be equal to the number of shares that are available to the investing public. And the easy example of this is, let's suppose we have a chief executive officer, and this chief executive officer is required through his or her contract, remember, legal and binding contract, to own, and let me just pick an exaggerated number. The CEO is required to own 10 million shares of stock. And as an owner, according to the terms of the contract, this CEO is not allowed to sell those 10 million outstanding shares. So even though they're outstanding, even though they're owned by the executive, you or I are not going to show up on the floor of the New York Stock Exchange and see the CEO selling his or her shares. So this is the float adjusted market capitalization weighting, where, notice the market float, the number of shares that are available to the investing public. And so that's really just the big difference between the market cap, the sole market cap weighting scheme, and this float adjusted market cap weighting scheme. And by the way, those indexes that you hear about every day, like the S&P, they follow this one here. Now, I mentioned this just a little bit ago about the possibility of finding some other kind of a characteristic to craft this index. So this is called fundamental weighting. And notice what we have in bolded down there: book value, earnings, dividends. I mean, you could come up with almost any of these other things. And so you might want to have a growth tilt. You might want to have a value tilt. You might want to have some other kind of tilt that we'll talk about at length, in some future equity readings. But I do like the second bullet point there. Fundamental weighted indices do the opposite by rebalancing to contrarian positions. This is one thing that I've learned during the course of my life. If everybody is saying this, then I'm going to go ahead and look for something else to do, right? If the whole herd mentality is saying do this, well, then maybe it's time to do something else. So I love any kind of research, and I read this all the time about contrarian views and contrarian positions. So just remember fundamental weighting according to, any kind of a characteristic. It could be value, could be growth, and then maybe a contrarian approach. All right, we did talk about rebalancing, adjusting the weights. Typically, this is done quarterly. It doesn't have to be. Price-weighted indexes are not rebalanced. Rebalancing is a minor concern because there's no reason really to rebalance those. How about reconstitution? I was saying this earlier, changing the constituent securities. So we can do this whenever we want. But the obvious example is the S&P 500 index, right? That's the index of the 500 biggest stocks that are traded. Well, remember there, that 499th stock, that 500th stock, and that 501st stock, they're all battling for size. And so if the 501st stock experiences a huge increase in price during a relatively short time, the 501st stock may jump up to be the 470th stock in this value relationship. And so that bumps 499 up to 500 and it throws out the 500 stock. Describe uses. All right, this is what I was saying about the Steph Curry and the Tom Brady in my first example. So look at this first one. Gauging market sentiment, right? Do we want to know whether the performance is upward or the performance is downward? We can get some decision about investor confidence. We can couple the index performance with what's going on over in the call option market and the put option market. We can couple that with the number of short sales that are out there. But these indexes, they give us a really good sense of what's going on in the market. They are proxies for return primarily, right? But they are also can be proxies for risk because it's clearly super easy to compute the return on the index. And it's easy to compute the standard deviation of the index or some other measure of risk. We'll talk about beta as we move through the readings. And then the third one here, asset class proxies. This, of course, is what we have with the Dow Jones Industrial Average, right? It's the 30, what do we call those things? The blue chip stocks. So these are the best and the brightest and the shiniest diamonds that are out there that are traded on the US and other exchanges there. How about active management benchmarks? I love this because we have, and I'm guessing that many of you are in this field as well, we have mutual fund managers who are actively managing their mutual fund. Plus, we have wealth managers that are actively managing their client funds. And we need some kind of a benchmark. I mean, clearly, you could take the easy way out and say, oh, let's go ahead and just use the S&P 500 index as our benchmark. But really, are the stocks inside the mutual fund or inside the managed funds, are they similar? Are they identical? Or are they completely different than the S&P 500 index? So these indexes out there, they provide a useful service for relative performance measures. And then model portfolios. Wow, these will dictate the investments and the weighting of, index funds, exchange traded funds. And so there's the passive part of this. That will say something like, look, all I really care about is to earn whatever the market portfolio means. And I'm going to invest in some broad index fund, a broad passive index fund. And so we need to make sure that we're doing the right kinds of indexing. And we have to compare that to, sure, the S&P 500 or the Wilshire 5000 or GIMS 75. Notice the very bottom there, usually at a lower cost than active management. Oh, we'll have fun times talking about that. All right, types of equity indexes. I've said this a couple of times here. I'm guessing you know this. So measure of overall performance, multi-market indexes, right, from different countries. I mean, you can take the Dow Jones 30 and you can take its similar analogy from the London market or from the Tokyo market or the Australian market. And so those multi-market indexes are really for those global investors who are interested in global diversification and global performance. And then you can do this for each sector, right? You can pick a sector or pick a segment or pick some other kind of a way to assign constituencies and assign weightings into an index. And then, of course, you have to worry about cycles. Some sectors do better in various phases, and then you can design an equity index that mimics the performance of some small sample of firms. And here's what I mentioned before: style indexes, right? We can, based on market cap, we can do it based on value or growth or some combination. We have tons of large cap and mid cap and small cap, but then what you can do is you can layer those, or you can chop those into more categories like value or growth. And then, of course, we can't forget about indexes that are non-equity indexes. I always tell students this. I always go like this. I say, look, here's the total value of the U.S. equity market, and here's the total value of the U.S. fixed income market. Can you see my hands all the way out here? Because that fixed income market includes Treasury securities, and as you know, we've got $30 trillion or so in 2022 of those Treasury securities. So there's a need for fixed income indexes. And so I could come up with, Jim's Treasury index. I could come up with Jim's default risk-based index. Like maybe I'll say something like, hey, these are all BBB rated stocks. Or I could come up with Jim's interest rate risk index, and I could say something like, hey, these have durations, these fixed income securities all have durations in excess of 5 or 7 or 10. So I can paint this in a broad market. I can identify specific sectors. I can do styles. And with the fixed income, because fixed income securities, are particularly sensitive to things like interest rates. And I'm not saying equities are not. Of course, equities are. But fixed income have perhaps greater sensitivity. So we can identify, different components of interest rate based on different economic factors. How about other indexes? So there are real estate indexes, there are hedge fund indexes, there are commodity indexes, and these are important for all of the reasons that we talked about in this slide deck. But over the last 20 years, especially since I went through the CFA program, which was, in the early 2000s, and I think I said this on a previous recording, the material inside of level 1 and level 2 and level 3 for alternatives, was about this big. It was solid back then, but now it's about this big. And so, of course, look at that first arrow point, right? Investors are looking for additional diversification benefits. So they want to invest in real estate, hedge funds, and commodities too. Are you ready for this? To increase the potential for return, but perhaps keeping standard deviation or keeping some measure of risk at least constant, or the relationship between the increase in return and the increase in risk on a portfolio-wide level then is beneficial to the investor. Yeah, let's compare indexes here. So what are we saying? Various asset classes, right? Equity indexes, fixed income indexes, and then commodity indexes. And so think about this. This is a great question on the exam. The equity indexes, think about New York Stock Exchange, think about the NASDAQ exchange. You got tons and tons of investors showing up on these exchanges every day. So the indexes based on those particular securities are probably, boy, what do we have in bold there? Highly liquid and easily priced. Now, the fixed income universe is just a little bit different. Of course, there are lots of treasuries that change hands every day. However, how many double C fixed income securities are bought and sold every day? It's not the 25 million that show up on the floor of the New York Stock Exchange trade one of these highly liquid stocks, I mean, it might be 50 bonds traded during one day. So notice we have in parentheses limited liquidity, which means we might have some difficulty in pricing those securities on a daily basis. We probably won't have any problem pricing them on, at least a monthly basis, maybe even a weekly basis, but on daily, we might run into some problems. Now, commodities, boy, think about this. Are we going to go down to the farmers market, which I love going to our farmers market on Fridays and Saturdays, but am I going to pick up a basket of cauliflower and a basket of Honeycrisp apples and a basket, of asparagus, or a basket, there's a great fish place down there, fish and oysters and clams. Am I going to do all that? Probably not. I'm just going to go to the Chicago Mercantile Exchange and look at futures contracts, because, boy, the oyster that I get at the farmer's market here in my city might be totally different than the oyster in some other city, Boise, Idaho, or Madrid, Spain. And so you got to have some consistency here. So the easiest way is just to show up on the floor of a futures exchange and say, hey, what's going on in the commodity market? Because those things are super liquid. And that takes us through our learning outcome statements. And so, sorry about that. Notice that we've got lots of describes in there. I think we covered it with this slide deck. So thank you for watching, and good luck studying.